This is the Value Investor Podcast with Tracy Reinick. All things value, all the time.
Welcome back, value investors. So with Warren Buffett basically riding off into the sunset now, we have a void on what kind of value investors, if any, are out there that we can follow, that, maybe we can take an interest in what they're buying. And it doesn't help that value investing is out of style, right? So that is also problematic. But maybe there is somebody and we've just not been paying much attention. So for those of you who did see the movie or read the book for The Big Short from back in the day, from the financial crisis, you may remember one of the traders who got it right about mortgage-backed securities, and his name was Michael Burry. But before he was buying MBSs and predicting the decline of housing, he was a self-taught value investor. He would spend his time in the value investing chat rooms of the first decade of this century and basically became known for trying to find undervalued companies. And since his success with his trade in the financial crisis, he stopped actually running money except for his own there for a while, but he's been back off and on the last several years. And recently he was in the news again for his investing choices. So now Michael Burry runs Scion Asset Management. And you can see those trades the same way you can see Berkshire Hathaway's trades on Whale Wisdom. That's what I use. That's where they post the 13 Fs, which are the filings that money managers have to do with the SEC every quarter. It's 45 days after the end of the quarter. They have to tell us what they've been buying and selling. It's not perfect because it's 45 days after, and they don't have to tell us when in the quarter they actually bought these things. But it gives you an idea of what they're doing with some of their money and where their interests are. So Michael Burry put on puts on a couple of stocks because in his fund, it is a value fund, but it can be long or it can be short. And he is making a statement against both Palantir, ticker PLTR, and NVIDIA. We all know that ticker, NVDA, as these are some of the most expensive stocks out there, although NVIDIA, not so much right now. So I'm kind of surprised to see NVIDIA on that list. But there's another stock that he's been talking about for a while. I don't think he has a position in it now. He has had one. He has shorted it in the past, I believe, but that's Tesla. He has also come out to talk about the valuations on Tesla. So is Michael Burry going to be kind of the barometer of when things just get a little too crazy out there? I mean, Buffett used to talk about valuations, but he would never come out with a specific call on a company or against one. He always liked to go long and not short things. But this is kind of new to value investors that someone is out there actually just pointing out that maybe some of these valuations have gotten just a little too crazy, and not just, saying that the whole entire market is too expensive. But Michael Burry actually writes a Substack now, and you can get that over on Substack, obviously. It's kind of like the blogging of old, right? Where you're sharing your investment ideas on Substack. And this week, he wrote about both Tesla and Palantir. And the press kind of appeared to maybe have gotten it a little wrong about what he wrote, but the main gist of it is that it is about valuations and that Tesla and Palantir are just too expensive. So he did write, and this is what he's posted on X. So you can get some of what he wrote on X if you can't get it on Substack for whatever reason. So he said Tesla dilutes its shareholders at about 3.6% per year with no buybacks. The chart above shows the kind of present value destruction that this level of dilution can impart. With recent news of Elon Musk's $1 trillion pay package, dilution is certain to continue. Tesla's market capitalization is ridiculously overvalued today and has been for a good long time. Then he has a little aside about the cult of Elon. I guess Elon cult is what he said. And then he talks about how it went from electric vehicles to autonomous driving and now robots. But then he switches to Palantir and he says, another beauty is Palantir, which has been diluting shareholders at about a 4.6% annual rate despite buybacks. Palantir has no earnings after adjusting for stock-based compensation. Palantir has the distinction of being the first billionaire revenue ratio greater than one that I have seen. 5 billionaires due to stock ownership and less than 4 billion in annual revenue. So, and that's where he ends it on Twitter, but you can read further on his Substack. So it's interesting that he is actually calling out the outrageousness of the valuations on both of these. So let's take a look just real quick at Tesla's valuation. It's always been expensive. That's a given. But its current forward PE is at 263 times. And I know many of you and many investors have said, I don't care so much about the PE because, well, this is forward, so it is looking forward because we are betting on the robotaxis and that autonomous driving system. And then we are betting on the robots. And this year, earnings expected to fall 32%. Nobody's surprised by that, given what's happening with the EV sales. Those are down sharply. But next year, analysts have it rebounding 44%. So they're hopeful that maybe things will be turning around next year. But these shares are trading near their all-time highs here once again. And the rest of the valuations are still pretty pricey. So price to sales ratio, which we like to look at for tech companies, is at 15. Now that's cheaper than some of the other competitors in the Mag 7 space and the robotaxi area. But anything over 10 is considered to be pricey for any tech company. It has a PEG ratio of 10. That's very expensive. And a price to book of 17. So none of these are cheap valuations. And the forward PE isn't really helping you. So a lot of people don't like to use the PE because maybe they look at the trailing and they're like, oh, that was done in the past. We look at the forward. Oh, this is what's coming in the future. But neither one is good for Tesla. They're both over 200 times. And just the valuations alone, you have to start to ask, when will the shareholders see a turnaround? When will something start, increasing those earnings and the sales? When will you get the business really operating at the premium that you're paying here? But Michael Burry, it sounds like, doesn't think you will. So that's on the Tesla side, very expensive. But that's why we're not in it as value investors. That's why growth investors are in it. But Palantir, ticker PLTR, that company has been growing the earnings. And this year expected to grow it 78% after 64% last year. And then next year at 42%. So these are nice, very growthy, earnings growth. It's very good for growth investors, but PE for Palantir is at 230. Very, very expensive. Again, PEG is a little bit better because we do have the better earnings growth, and Tesla had a negative earnings for this year. So PEG is at 4.6, a little better. but price to book is 60, and price to sales, this is one you're not going to really believe, but price to sales is at 102. 102. And anything 10 and over is extreme for a tech company, but this is at 102. So you can see again why Michael Burry, as a value investor, is calling out these outrageous valuations and just what is going on with some of these. Now, what companies does he own? Well, he did put the put on NVIDIA too. But NVIDIA, like I said, isn't as expensive as these others. It's not cheap, and it hasn't been for basically the last 20 years. It has not been cheap. But right now, PE, the forward PE, we have at 38 times for NVIDIA. That's a little bit under. It was trading in the 40s range. But look at that PEG ratio because those earnings are rising. It's at 0.8. That's a value PEG ratio. I've been known to buy stocks just based on the PEG ratio, which is the PE divided by the growth. So even with that PE at 38, the growth rate is so strong right now. We are getting the PEG under 1, which means both value and growth. That means we're getting a discount on the growth there. But price to sales, it's always been elevated. It's at 23. But that looks a little cheap compared to Palantir. And price to book is at 36. That's not a surprise either. Very stretched. But that PEG really stands out. So NVIDIA, not altogether super expensive here. And, it is attractive, but not in classic value fundamentals, except for that PEG, which is intriguing. So what other companies is he looking at? He does tend to change his portfolio very often. So he's not like buying and holding. He is much going by the trends and looking for value in stocks that have maybe sold off. And he thinks that, they've been oversold. And one of those is Lululemon. That's in his portfolio, ticker LULU. And Lulu now trading with a forward P of just 14. It does have a PEG of 11, however, and that's because earnings are expected to fall this year. This is fiscal 2026, down 11.9, and then 2027, only growth of 0.7. I used to be a shareholder of Lululemon for a number of years through the pandemic. And you, without a doubt, got double-digit earnings and sales growth. And now you're getting single-digit sales and a decline in earnings. And next year, sales also single digits, 5.1% on very modest, if anything, growth on the earnings side. So this is a change in the story for Lululemon. It has done the double digits for well over a decade. Even into the Great Recession, it was still producing these solid numbers, but it's very hard for a retailer to stay on top for even that length of time. I did sell my Lulu a year ago, maybe 2 years ago, because of this decline in the earnings. And you knew that trouble was ahead. There are more competitors out there now, and they have slipped a little bit in being like the prestige brand as well. Athleisure appears to maybe be dying down. It was the hot area of retail for well over a decade, but it does seem that maybe, jeans are coming back, sweaters, things like that are not athleisure per se. So this is all things you have to watch when you're getting a retailer that is really sold off. And right now, there are a lot of retailers that have really sold off. But Lulu, it does have that low forward PE now of 14. And so it does have some of these valuations. But is it a trap? It looks a little trappy with that moderate to almost no earnings growth for next year. Price to sales is at 1.98. So that's pretty low. It's not at the classic value level yet, but it would take another step down in these shares, which are already trading near 5-year lows, to really get some of these valuations down. But never say never in a recession. Lulu is global, so it looks like it's turning around its Chinese business a bit, and that should help. But this is one I'm going to keep my eye on, but he decided to go in on these 5-year lows. So we'll see, but this is a value play here now. So I'm not surprised to see, one of the big value investors in it. Another one that he's in is Molina Healthcare, ticker M as in Mary, OH, MOH. And this one is a number 5 on the Zacks rank. And the estimates are all being cut. It did have a big miss last quarter. It's also at 5-year lows. Earnings expected to be down 38% this year and 1.8% next year. So a bit of a value trappiness there. And again, the analysts are like, something's happening. We've got to cut, because they're cutting all the way through 27 on the chart. Now, what about the value proposition here? If it's at 5-year lows, forward PE is at 10.4. So that is cheap, but it's a little bit of trappiness with those earnings being cut. Price to book is at 1.88. That's cheap. I look for 3 and under, so that is classic value there. Price to sales just 0.18. Very cheap. Under 1 gives us growth and value. For some reason, it's not giving me the peg, probably because it's negative. So Molina, the analysts are bearish. 7 estimates have been cut for this year and next year in the last 60 days. So we're looking at, everybody in agreement. Nobody is raised in that time period, and 1 is even lower in the last 30 days. And last year they made 22.65, expected to make 13.95, and then 13.70 for next year. So not a lot of hope for growth there. But he's maybe thinking, I'm getting it cheap enough, and how much lower can it go? So we'll see. But that's Molina Healthcare. And a lot of these healthcare stocks, are looking on the value radar because they do have these cheap valuations. But this is healthcare, and healthcare has been in the news, shall we say, the last couple of weeks. And this one does a lot under Medicaid and Medicare programs, it says. So maybe that's why the estimates are coming down. A lot of that is predetermined by the government, like what rates they put on and everything. So that's Molina Healthcare, MOH. I can't say I'm super enthused about that one, but this is what happens when you're a value investor, right? Normally, we don't see the stocks that are on the rise. We see the ones that are on the fall. And then you do have to sift through whether or not they're true values or traps of some kind. So keep that all in mind. But still interesting couple of choices. He has a couple others that are in the portfolio right now. I encourage everyone to go look at, just kind of check in and see what he's doing. There's a couple other value investors that also post their 13 Fs. And maybe I should do another podcast to cover some of what they are doing, because it is good if Buffett is fading off the scene, which he is, to have some other people who've been in the value game for a while. It's been 20 years for Michael Burry investing in value stocks and trying to find that contrarian play. And I do appreciate him, calling out some of these very expensive growth stocks, because nobody said they're cheap, but valuations are really stretched now on some of these. So let me recap some of the stock tickers again. So he mentioned Tesla. He does not currently have a short on it, but it is very expensive. Ticker TSLA is the ticker. Does have that forward PE of 263 right now. Then Palantir, that has a forward PE of 230. Ticker is P as in Paul, L as in Larry, T as in Tom, R. PLTR is the ticker. And then NVIDIA is on here, but I actually still do like it if I'm going to buy one of the Mag 7s. It is among the cheaper of the Mag 7s now. Ticker N as in Nancy, V as in Victor, D as in David, A. NVDA, it does have that PEG ratio of just 0.8. Remember, that is a value PEG ratio. Then he owns Lululemon, which is LULU. It is cheap right now with the PE under 15 at 14 times, but is it going to continue to slide? What is going to happen? This holiday season is crucial, and I'm not sure I want to make a bet on the consumer right now, but he is LULU, again, is the ticker. And then we had Molina Healthcare, ticker MOH. A lot of cheap stocks in the health insurance side, but it is a Zacks number 5 strong sell here because those estimates are really being cut right now. And we have a decline in earnings expected of 38% for this year and 1.8% for next year. But if you want to keep it on your watch list, ticker is M as in Mary, O, H as in Harry, MOH. So as always, I'm looking for value stocks. Everybody is. Michael Burry is too, right? We're all looking and wondering what the patterns are going to be for next year. What area is going to be the big turnaround for next year? We saw AI revolution stocks really take off this year. We saw the gold miners really take off. They were cheap and they're still cheap, but they were, very cheap at the start of the year, and then gold took off. So that's always going to help the gold and silver. Silver took off too. It's going to help all of those miners. But what is it going to be for 2026? I'm going to have a couple podcasts on this as we go through December 2025 here. So be sure to subscribe. Make sure you're getting us on YouTube. We have a whole podcast channel there, so you can get my podcast, The Value Investor, is there, as well as Nina's ETF Spotlight. That's a great podcast. And all of our others, including John Blank's monthly podcast, that just kind of give a lay of the land about what's happening in the economy. But be sure to subscribe there or you won't get any of them. It'll give you notifications when the new one comes in. And it's easy to just get us on Zach's podcast. Get that page. It's different than our main homepage, but you'll just get the podcast. There's no video, just audio alone. Or get us, of course, on Apple. We're on Spotify. We're on Amazon Music. Just about anywhere you get audio podcasts, we are. But be sure to get us somewhere, and I will see you again next week with some stocks, hopefully to look for in 2026.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.